exempt versus countable assets, what you can keep. Let's make this simple. Some things you can keep without hurting eligibility, some things count against you, and a few sit in a gray zone that depends on your state. Knowing which is which lets you spend down cleanly and avoid penalties. Start with the big one, your primary residence. In many states, your home is exempt while you're alive if your equity is under a state-set cap, and you express an intent to return, even if that's not realistic. If there's a spouse or certain dependent relatives living there, the home remains exempt during your life. Don't confuse exempt now with safe forever, though. Estate recovery can pursue the home after death if it passes through probate, and no protected survivor blocks recovery. We'll hit recovery later. For now, know the home can be exempt during eligibility. Plan both entry and exit. Next, one vehicle is typically exempt, regardless of value if used for transportation. Personal belongings and household goods are exempt. Furniture, clothing, basic jewelry. Burial spaces for you and immediate family are exempt. Prepaid, irrevocable funeral and burial contracts are usually fine when documented properly. These are clean spend-down targets because they meet real needs and don't trigger penalties. Retirement accounts are where state rules diverge. In some states, an IRA or 401k in payout status with required distributions can be treated differently than one you can liquidate freely. The account value might be countable, or only the monthly distribution may count as income. This is a check your state item. Same with life insurance. A small face value policy may be exempt, but policies with cash value often become countable above a small threshold. Ask specifically how your state treats cash value. Now the countable side. Cash, checking, savings, non-retirement brokerage accounts, CDs, second properties, vacation homes, non-exempt annuities, and multiple vehicles beyond the one allowed. If your name is on an account, Medicaid will presume the funds are yours unless you can show deposits came from the other owner and you didn't use the money. That's why joint accounts with adult children cause trouble. Commingled funds are hard to untangle, and during the lookback, they'll be scrutinized. Community spouse protections matter if you're married. The spouse at home can keep a certain amount of the couple's countable assets, the community spouse resource allowance, and enough monthly income to reach the minimum monthly maintenance needs allowance. The numbers are state-specific and adjust periodically. The key idea: you don't have to spend everything down to zero if there's a healthy spouse at home. Structuring assets to maximize those allowances is one of the most impactful planning moves. Here's the thing most people miss. You can often convert small countable assets into exempt items quickly and legitimately. Examples: pay off medical and dental bills, buy an irrevocable prepaid funeral plan, replace unsafe flooring, fix the roof, install grab bars, and a ramp. Home modifications that support care are legitimate. Purchase a reliable primary vehicle if you need one. Upgrade a worn-out mattress or a lift chair. These are not gifts, they're fair value purchases with receipts. Practical move today: categorize everything you own into 3 buckets: exempt, countable, risky. Exempt: home, subject to limits. 1 car, personal items, irrevocable burial, possibly retirement accounts depending on state and payout status. Countable: liquid cash, investments, second properties, extra vehicles, cash value life insurance above small limits, most non-compliant annuities. Risky: joint accounts with kids, informal loans to family, assets titled in ways that blur ownership, trusts you can still control. Risky doesn't mean illegal. It means likely to trigger questions or penalties without expert cleanup, and the fix is usually paperwork and timing, not magic. Let me show you exactly how to use this. If you're single and over the asset limit by, say, $12,000, don't gift it. That would create a penalty. Instead, spend down on exempt needs. Prepay funeral/burial with an irrevocable contract. resolve dental work, pay for durable medical equipment, and handle home safety improvements. Keep every invoice, receipt, and proof of payment. You drop under the limit without triggering the look back. If you're married, coordinate with the community. Spouse allowances. Move countable assets to the spouse as permitted. Evaluate a Medicaid-compliant annuity where appropriate in crisis states that allow it. And ensure the spouse retains enough income and resources inside the rules. Documentation is everything. Statements showing transfers between spouses, annuity contracts, and verification letters. Common mistake: selling a house or car to family below market without an appraisal. That turns part of the value into a gift. If you need to sell, get a written valuation or market comps, list it if possible, and show the sale was at fair value. Another mistake: cashing out life insurance with cash value on the eve of application, then gifting the proceeds. That stacks a countable asset and a transfer penalty. Better, evaluate whether to surrender and spend down on exempt items or keep if under the exemption. A quick win. Pull policy summaries for any life insurance and annuities, note cash values and surrender penalties, and ask your state Medicaid office or an elder law attorney how those instruments are treated locally. You'll avoid surprises and can line up clean spend downs. If you remember nothing else from this section, exempt means usable without disqualifying you now, countable must be reduced or restructured, and risky needs cleanup and documentation. Convert countable to exempt with fair value purchases, never with gifts. Keep receipts. Protect the community spouse's allowances. And always think 2 steps ahead about estate recovery on the home. Timing and paperwork turn the same dollars from a problem into a solution and into approval instead of penalties. Timing strategies when planning still works. Timing decides what tools you can use without blowing up eligibility. Think of it in 2 lanes. Outside the 5-year window, you can move proactively. Inside the 5-year window, you switch to cleanup and documentation. The mistake is trying to use outside the window moves when you're already inside. That's how penalties happen. The calendar is either your shield or your trap. Let's start with early planning, more than 5 years before you might need care. This is where you can make documented, fair transfers and let the clock run. If you want to help kids or reposition assets, do it cleanly with receipts and market values. If a trust is part of your plan, it needs to be the right kind, typically an irrevocable trust you don't control and don't benefit from. So transfers to it are treated as completed gifts. Then you wait out the full 60 months. The clock wipes those transfers off the look back, and you keep flexibility later. Now, the reality most families face: crisis or near crisis planning inside 5 years. This is not the time for gifting. Every disqualifying transfer you make now creates a penalty and starts a new 5-year clock on that transaction. So pause all gifts. Your focus shifts to damage control. Identify past transfers, document fair value. Where possible, reclassify legitimate expenses and convert remaining countable assets into permitted exempt items with airtight paperwork. Here's the part that separates beginners from pros. The clock resets with each disqualifying transfer. If you gifted $5,000 4 years ago and then gift $2,000 today, the earlier gift is only 1 year away from aging out, but the new gift traps you for another 5 years on that piece. That's why stopping gifts immediately is powerful. You freeze the damage and let older transfers slide off the look back as time passes. Waiting for a formal diagnosis before planning is expensive. Families often tell me, "We'll handle this if mom gets worse." But long-term care needs often jump after a fall, stroke, or hospitalization. If you start at that moment, you're private paying $8,000 to $12,000 a month while you untangle 5 years of records. Acting before decline means you can set up care contracts, prepay burial, fix the house for safety, and if you're outside 5 years, complete transfers that won't be penalized later. Once you nail that, everything else clicks. Inside 5 years, you work the levers that don't trigger penalties. Spend downs on fair value needs. Personal care agreements that pay family at market rates with timesheets. Spousal strategies that shift assets within the marriage under allowed rules. Medicaid-compliant annuities for the community spouse in states that allow them. None of these create disqualifying transfers when they're structured correctly and documented. Your advantage is speed plus receipts. Let me give you a quick timing decision tree. If you're outside 5 years, consider whether any gifts or trust transfers make sense, but only if you can afford to lose control of those assets and still cover 5 years of care if needed. Start the clock now, not after symptoms show up. If you're inside 5 years, no gifts, no bargain sales, no last-minute title changes. Build your Medicaid binder, categorize assets, and plan spend downs you can execute in weeks, not months. Micro story. 2 sisters called me about their mom. Family, they started planning at month 61. They'd moved modest assets into an irrevocable trust, documented every move, and kept mom's spending clean. When a stroke hit at month 63, there were 0 look-back penalties. They spent down a small cash cushion on medical needs, filed a tight application, and Medicaid approved on the first pass. Family B started at month 47. They had 2 years of sporadic gifts and a house sale to a son at a discount. The penalty stretched several months, and they private paid while we scrubbed records, got an appraisal to fix the house valuation, and set up a care contract to legitimize payments to a daughter. Same love for mom, different timing, 6 figures of difference. Before we continue, you need to understand the tempo. Timing isn't just calendar math, it's paperwork velocity. The sooner you stop risky activity and start clean documentation, the faster you shorten private pay time. If the application is in sight, you want your last 60 months organized, explanations drafted, and purchases completed with receipts. Momentum cuts costs. Action steps you can do this week. First, freeze gifting. Second, map your timeline. Are you outside or inside 5 years on any past transfers? Third, list time-sensitive fixes. Appraisals for any family sales, written care agreements if family is helping, and quotes for exempt spend-down items like burial and home safety upgrades. Finally, schedule a consult with a local elder law attorney to confirm state-specific rules, especially for retirement accounts and spousal. Options. If you remember nothing else, outside 5 years, you can shift assets with patience. Inside 5 years, you clean up, you document, and you convert Countable to Exempt without creating new landmines. The clock is either your ally or your enemy, depending on when you start. Legal tools that don't break the rules. Now let's use tools that work inside the rules so you can protect cash flow without triggering penalties. Think of these as clean levers. They convert countable assets into allowed forms, pay for real needs at fair value, or shift resources between spouses under specific rules. Done right, they're mechanical, documented, and penalty-free. Start with Medicaid-compliant annuities for the community spouse. In crisis cases where one spouse needs nursing home care and you're over the resource limit, some states allow the community spouse to turn excess countable assets into an immediate, irrevocable annuity. The payout goes to the community spouse, not the applicant. Key requirements. The annuity must be immediate, non-assignable, actuarially sound based on life expectancy. Name the state as remainder beneficiary up to benefits paid, and pay out in level payments with no balloon. When those boxes are checked, the asset turns into an income stream for the healthy spouse and is no longer countable for the applicant. This is timing sensitive and state specific, so coordinate with an experienced local attorney and get the contract language exactly right. One wrong clause can tank eligibility. Next, spousal transfers. Within a marriage, you're generally allowed to transfer assets between spouses without creating a penalty. This is critical in crisis planning. You can move countable assets to the community spouse's name, Then use the community spouse resource allowance to protect a chunk of those assets. In some states, spousal refusal exists. The community spouse can refuse to support the institutionalized spouse, forcing the state to determine eligibility based on the applicant's resources alone, while reserving the right to seek contribution later. It's a niche strategy, very state-dependent, and comes with potential legal follow-up from the state. So only use it with counsel who handles it regularly. Personal care contracts are the game changer most families overlook. If a child is providing care, pay them at fair market rates under a written agreement signed before services are rendered. Spell out duties, hours, rate, and start date. Keep timesheets and proof of payments. This converts what would look like gifts to kids into legitimate documented expenses for care. 2 traps to avoid. Don't do lump sum back pay without clean logs. It's often treated as a gift. And don't set a rate above local market. If the area pays $22 an hour for home care, don't write $40. Paper first, payment second. Spend downs are your cleanest tool. You're allowed to spend countable assets on real needs at fair value: medical and dental care, vision and hearing, durable medical equipment like wheelchairs or lift chairs, home safety modifications, grab bars, ramps, wider doorways, necessary repairs, and an upgrade or replacement of the one exempt vehicle. Prepay for an irrevocable funeral and burial within state limits, and keep the contract. Pay off legitimate debts. The key is receipts and invoices that match bank statement payments. If it doesn't look like a normal household or medical expense, expect questions, so prepare explanations in writing. Funeral and burial pre-need plans are simple and effective. Use an irrevocable contract with a reputable provider, itemize what's covered, and keep the policy declaration. Burial spaces for you and immediate family are typically exempt. This not only reduces countable assets cleanly, but also takes pressure off family later. Home modifications deserve special mention. If returning home is part of the plan or the community spouse still lives there, spending on safety and accessibility is both practical and compliant. Document contractor estimates, permits if required, paid invoices, and completion photos. Medicaid reviews love seeing necessary improvements tied to care needs. When does each tool fit? If you're single and inside 5 years, lean on spend downs, prepaid burial, medical work you've been postponing. And if family is helping, a properly executed care contract going forward. If you're married, coordinate spousal transfers to reach the community spouse resource allowance. Evaluate a Medicaid-compliant annuity if your state allows it in crisis, and ensure the community spouse retains enough income under the minimum monthly needs rules. If you're outside 5 years and considering an irrevocable trust, understand you must give up control and benefit. Otherwise, it won't remove assets from being countable or from estate recovery in some states. Always start that clock, only if you can safely cover 5 years of potential care. Common mistakes to avoid with these tools: buying an annuity that isn't Medicaid compliant. Wrong terms turn it into a countable asset. Writing a vague caregiver agreement without timesheets looks like gifting. Prepaying a funeral with a revocable plan, still countable. Paying relatives for home repairs without invoices. No paper trail equals gift. And mixing spousal funds into joint accounts right before application without clear statements confuses ownership and slows approval. If it would confuse a bookkeeper, it will confuse Medicaid. Clarify it on paper. If you remember nothing else here, legal tools work when they're boring and documented. Use compliant annuities only for the community spouse. Transfer within marriage under the rules. Pay family with signed contracts and timesheets. Spend down on real needs with receipts. And make burial plans irrevocable and itemized. The right tool at the right time turns a penalty risk into a clean approval path. The landmines: common mistakes that trigger penalties. Now, here's where most people mess up. Innocent moves that look fine in normal life, but explode under Medicaid review. First, gifting to kids to keep it safe, inside 5 years. You move 10 grand to a daughter's account for emergencies. On paper, That's a transfer for less than fair market value. There's no service rendered, no product bought, no contract. It's a gift, and it stacks into the penalty math. If you want to help a caregiver child, use a written personal care agreement going forward, rate duties, timesheets, payments by check or transfer with memo lines. Retroactive lump sums are almost always treated as gifts. Second, selling a house or car to family below market without an appraisal. You think you're being practical? We'll give our son a deal. Medicaid sees the difference between market value and the sale price as a gift. Fix it before application. Get a professional appraisal or comparable sales. Show a listing history if possible, and sell at or near the documented value. If the property needed work, gather contractor estimates and photos to justify a lower price. No paper trail, no fair value. Third, cash withdrawals with no receipts. Pulling out $300 here, $800 there. Then tossing receipts is a fast road to trouble. Caseworkers don't assume the best. They need evidence. If you've already withdrawn cash, reconstruct what you can, ask vendors for duplicate receipts, gather credit card statements for adjacent purchases, and write clear explanations. Going forward, pay by check or card for big items. If you must use cash, keep itemized receipts and write the purpose on them the same day. Fourth, joint accounts with adult children and commingled funds. My name's just on there to help mom. Medicaid presumes funds with the applicant's name are theirs unless proven otherwise. If the child deposited their own paycheck into the joint account, you need deposit records showing the source and that the applicant didn't use those funds. Better structure. The child has view-only access or a durable power of attorney, while funds remain solely titled to the parent until you can cleanly separate. Fifth, moving money between accounts right before applying. Shuffling balances across banks or between owners without a clear reason and documentation triggers extra scrutiny and delays. The fix is simple. Keep a transaction log explaining any large or unusual movement, date, amount, purpose, destination account, and attach supporting statements. If you're consolidating to simplify, say so and show both statements. Sixth, informal loans to family. You write a $5,000 check to a grandson as a loan with no promissory note and no repayments. Medicaid treats it as a gift. If it truly was a loan, you need a signed dated promissory note at the time of the loan, market rate interest, a set repayment schedule, and proof of payments. No retroactive paperwork. Seventh, reimbursing family caregivers without a pre-existing agreement. You pay your daughter $12,000 at once for the last year of help. Without a signed contract and time logs, that's a lump sum gift. Clean approach. Sign a care agreement now. Start paying going forward at market rates. And if your state allows limited retroactive pay, support it with detailed logs and proof. Many states won't accept back pay at all. Confirm locally. Eighth, prepaying funerals with revocable plans. Revocable equals countable. Use an irrevocable pre-need contract within state limits, itemized with the funeral home's documentation, and a receipt that matches your bank statement. Burial spaces are typically exempt. Record the purchase. Ninth, DIY annuities and financial products. Buying an annuity that isn't Medicaid compliant turns cash into a still countable asset and can lock up funds you need. The contract must meet specific terms. Immediate, non-assignable, actuarially sound equal payments, and the state named as remainder beneficiary up to benefits paid. Anything else wastes time and money. 10th, title changes. Without understanding consequences. Adding a child to your deed or bank account inside 5 years can create a transfer. Some deed types avoid probate, but don't avoid the lookback or estate recovery. Before you change titles, check your state's treatment and document the purpose. Microstory, the $5,000 car sale. A son bought mom's 10-year-old sedan for $5,000. Blue Book in fair condition, said $9,200. No mechanic report, no photos of damage. Medicaid counted $4,200 as a gift and added nearly half a month to the penalty. We salvaged it by getting a late mechanic assessment and repair estimates that showed transmission issues, pulling the fair value down to about $5,800. The gift shrank to $800 and the penalty dropped. Paperwork made the difference. 2 more quiet landmines. Charitable giving beyond a long-established pattern. If you've tied $100 monthly for years, staying consistent is defensible. Suddenly writing $5,000 checks in the year before application raises flags. And credit card points games, buying gift cards or making odd purchases that look like pass-throughs. Invite questions unless receipts clearly show legitimate household spending. How do you avoid these traps in real life? Use 3 habits. First, write first, pay second. Draft care agreements, promissory notes, and purchase estimates before money moves. Second, document market value every time. Appraisals, comps, repair estimates, invoices. Third, keep a running transaction log for 5 years. Date, who, what, why evidence. If you can hand a caseworker a binder that tells a clean story, approvals move faster and penalties shrink. Simple habits beat expensive mistakes. If you remember nothing else, gifts, bargains, cash, and guesswork create penalties. Contracts, fair value, and receipts prevent them. Move like a bookkeeper, not a gift giver.